Sources of finance. Unit 2. In Unit 2 we look at growing as a business. As a larger firm, it is easier to raise finance. One source of finance for a larger firm is retained profits. These are the profits that have been kept by the owners. A firm can also sell fixed assets that are no longer in use. However, there is a limit to how many assets you can sell. Limited companies can sell shares on the stock market and they don't have to be repaid. However, the more shares you sell, the less control you have. Banks are more willing to lend money to larger firms because there's less risk of them failing, but loans and mortgages have to be repaid with interest. Debentures can also be issued by limited companies. Debentures are long-term loans that are repaid with interest. These can last for over 25 years, and the people who lend the business money don't own any part of the business. The trading profit and loss account records the difference between the firm's income and the cost of running the business over a period of 1 year. The trading account records the firm's gross profit or loss. Gross profit is the difference between the revenue from selling the product and the direct costs of making it. The profit and loss account records all the indirect costs of running the business. The money left after paying all the costs of running the business is called operating profit. To calculate the net profit, any interest paid or received is included. Limited companies will also have an appropriation account to record where the profit has been used. A firm's stakeholders will find the trading profit and loss account useful because they can assess the performance of the business. The gross profit margin shows the fraction of every pound spent by customers that doesn't go directly towards making a product. The net profit margin is the fraction of every pound spent by the customers that the company gets to keep. Balance sheets record where the business has sourced its finance from and what has been done with it. The sums balance out exactly. Stakeholders use the balance sheet to assess the financial health of the business. The current ratio shows whether a firm has enough money to pay its debts this year. The asset ratio assumes that the company won't be able to turn stock into cash.